The US dollar strengthened again as Donald Trump renewed his tariff threats. Now, it's a 25% tariff on imports of cars, semiconductors, and pharmaceuticals. Following the established pattern, the US president has postponed the possible implementation data to early April. The world possible increases anxiety for countries exporting these goods to the United States and boosted the greenback against the currencies. Additionally, the dollar has already risen as a safe haven asset amid negotiations between the United States and Russia. Meanwhile, Forex currencies continue to react to incoming macroeconomic data. You are watching Traders Calendar for February 21st. It seems that Australia's manufacturing sector was finally emerging from a contraction. In January, its PMI exceeded the key mark of 50.2 points, recording to the first expansion in a year. However, preliminary forecasts for February are again below the critical level at 49.9 points. These figures leave the Australian dollar with no reason for optimism. New orders are declining and cost pressures continue to rise. A weakening economy makes the national currency fall. At the same time, higher resource costs push selling prices up, fueling inflation expectations. However, investors are in no rush to bet on the Australian dollar amid global instability. In the case of the Japanese yen, the situation is different. Inflation in the country has already accelerated to 3.6%, the highest level in a year. The main drivers are rising electricity, gas, and food prices. Rising prices increase the likelihood of more aggressive auctions by the Bank of Japan, and this means the chances of a rate hike this year are growing. Investors have already started pricing in this scenario, putting pressure on the US dollar and supporting the yen. However, if inflation falls short of the 3.7% forecast, the market reaction may be less pronounced. British consumers appear to be sinking even deeper into pessimism. Over the past 2 months, the consumer confidence index has plummeted from a minus 17 to minus 22 points, marking the sharpest drop since 2011. Moreover, all key components of the indicator may turn to negative. February forecast around minus 23 points reflect growing household caution and add more pressure on the pound sterling. In such conditions, expectations of a Bank of England rate cut this year are becoming increasingly realistic, weakening the pound against the US dollar. The UK retail sales report will not bring positively to the pound either. In January, the data is expected to show a sharp slowdown in growth from a 3.6 to 1%. Considering the near-zero reading in November, the January jump looks more like a temporary spike than a sustained trend. Please pay attention to the time of the publication. Overall, on a Friday, February 21st, the macroeconomic calendar will be rich in PMI reports, including services, manufacturing, and the composite. For example, in Japan, the manufacturing PMI is expected to rise to 49.3 points in February. This is a higher reading compared to the one seen in January, but is still below December's 49.6 points. However, the upward trend should strengthen confidence in the yen and lower its rate against the US dollar. A positive trend for the euro is also possible on this day, at least from an economic data standpoint. Germany's manufacturing sector is expected to recover slightly in February, with the PMI increasing by 0.5 points to 45.5. This is still below the key 50 mark, but the slowing decline is encouraging. If the data confirms a turnaround in the industrial sector, the euro will react positively. The Eurozone is also gradually recovering from its crisis. The manufacturing PMI is expected to rise from 46.6 points to 47.0 points. Investors may take this report as a signal for a rise in the euro. As you can see, neither Asia nor Europe has yet caught up with the US economy in terms of this indicator. In January, US manufacturing PMI entered expansion territory. with the production growing for the first time in 6 months. The indicator rose to 51.2 points, and February is expected to record another increase, bringing the index to 51.5 points. Economic growth will support the Fed Reserve's hawkish stance, which in turn will strengthen the US dollar. However, other Friday data could prompt the US dollar to slow down. First, US existing home sales are expected to decline in January, and this suggests that the US real estate market is starting to slow down after 3 months of growth. Against this backdrop, the greenback may come under pressure. The consumer sentiment report from the University of Michigan could be one more factor weighing on the greenback on this day. While American consumer optimism was measured at nearly 74.5 points in December, February's indicator is already expected to be below 68 points. And if consumer sentiment weakens, the economy also starts to slow down as the currencies yield does. Speeches from the key central bank officials are also expected this day. Comments from financial policymakers often cause volatility in the currency market as they may signal future rate policy decisions. Please note that the time of above-mentioned publications is set